Okay, good morning, everybody. This is Nick Webb. I'm in for Dan Russo, who continues his honeymoon through Italy. Today is Friday, June 28th, 2019. This is the stock market today, brought to you by Chaikin Analytics. So happy Friday, everybody. Let's get started. Let's take a look at what happened to the market. Market actually had a up day, first up day in a week. If you look at the S&P, Dow's been barely positive a couple times. The S&P, however, continues to trade in a very narrow range. It's out there scouting for more news and it's looking for direction, but right now it's stuck in this very narrow channel. You've got support at 28.75 and resistance at 29.50. You can see it tested that resistance a couple times back when it was almost, well, when it did make new highs last week, hit that 29.50, and you could tell that there was market resistance right there. Good news, the futures market points to a higher open today, so that's good. Major action in banks, we'll get into that in just a bit. Just one note of caution, and this is continuing to show up here, so it's got to be addressed. Money flow, which is institutional buying for the S&P, is still negative, and it's becoming consistently negative. And you can see in periods past where it was negative back like in October, November, that was a precursor to some of the market fall. And then late in December, that led the final capitulation of the market pullback, correction, bear market, whatever you want to call it. All of a sudden you saw money flow go negative, and then all of a sudden the bottom dropped out of the market. So again, this is something to watch because you don't like to see this. So obviously we've got a big event happening this weekend. The Trump and Xi meeting are set up. He's already in Japan. There's been all the pictures. So all that's left now is for the meeting. Now remember, they're significantly ahead of us in time. So by the end of the day today, or yeah, you know, by 9 o'clock, 10 o'clock today, that's when they will start meeting over in Japan. The market finishes positive. We talked about that. Another area of caution is, and we will get into this later in the show, is the yield curve is partially inverted, and it actually steepened over the last couple of days. So is it a bad sign? I think it may be a sign that, you know, the market is almost pressuring the Fed to ease, and we'll talk about that later on. There's really good news in the market, particularly for the major banks. The top 14 banks have to go through what they call the Fed's stress test, and all of them passed it. So that's a good sign. I see it as, you know, each bank sort of running home very proudly waving their Fed report card, and the shareholders rewarding them with an ice cream and a 2% price gain, which I think you'll see 1 to 2% positive price movement on each of the major banks today. Like we said, futures point to a positive open. If you look over at the major indices, you can see down, slightly down. Honestly, I don't really view Dow as a serious index. It was down yesterday because of Boeing. One stock pulled it down. Without Boeing there, it would have had a very nice positive day. S&P was up by 1/3%, and same with the NASDAQ. And small caps made a big move yesterday. So good for them. They've been lagging behind the market, and yesterday they really began to take off. So that's great to see. Again, it's that market breadth that all of a sudden you begin to realize there's a groundswell. So hopefully that continues. You know, in the S&P 500 sectors, though, it's been a dismal 5 days. Like I said, yesterday was the first positive day, and even that wasn't a massively positive day. So you can see that in general, every sector has been down over those 5 days. Real estate is really troubled at this point, which is surprising. You know, you look at the fundamentals for real estate, and you've got a reasonably strong economy with good unemployment. you would expect wage gains there, or income growing, and interest rates. The long-term interest rates are really taking a dive. So mortgage rates have become cheaper. So it's really kind of a disconnect between the fundamentals. But they're having a very tough time on the upper edge of their market. So the larger, more pristine houses just are not selling. And so they've shuttled their mix down to starter homes, and there's just not enough money in that for them. Our industry focus today is the capital markets. You can take a look at the power bar. It's strongly positive, 20 positive or very bullish and bullish stocks versus 2 that are bearish or very bearish. That's a pretty strong ratio. So it's ranked number 2 out of the 21 subsectors. While it has underperformed the S&P 500, got to remember that the Chaikin Power Gauge rating is not looking in the rear view mirror. It's no taillights. We're all about the headlights. So our ratings are forward looking. So we're saying, hey, it may have underperformed, but there's really good potential in this industry going forward. Let's take a look at one of them that I used to go travel to on a regular basis. Stifel Financial, great little stock in the Midwest, St. Louis. You can see it is, well, let's read it the way Chaikin would read it. Start with up in the left-hand corner, very bullish. Then you go down and you take a look at the track record for that, and you can see that it has been bullish really since January. Go up a notch and you can see, good relative strength. So it's been outperforming the market. So if you think about it, Chaikin likes this stock. The market likes this stock. The third leg of the stool is Chaikin money flow, which isn't as fond of the stock as Chaikin and the market in general. What that means is that institutions are using some of the market strength to sell into it. And while it's not strongly negative, it's slightly negative. That does sort of provide a headwind in terms of making solid upside moves. So you really need money flow to turn positive for Stifel to get going again. With that said, though, one of our signals triggered a relative strength buy. That's a good sign that not only, if you think about the power gauge, that's a 1 to 6 month indicator. A relative strength buy signal is about a 6-week indicator, saying that there should be good momentum for them for the next 6 weeks. So good looking chart in general. The stock of the day is Science Applications International Corporation, I think is the full verbiage of this. Again, it's another great looking stock. Let's go do the Chaikin Analytics review. Very bullish stock, so that means fundamentals are very strong. Go along the power gauge track record, and you can see, again, we've been strong on it really since February. And the market has rewarded Chaikin for that. It's been a good call. Relative strength has been strong really since start of June, so not as long, but it's outperforming the market. So Chaikin and the market like it, and in this case, money flow likes it. Although that's been decreasing recently, so not as impactful as it used to be. Another piece in terms of market timing, if this was a stock you wanted to buy, you can see it's sort of dipping into the oversold category. This could be again, sort of a nice, good time to buy. What we tend to look for at Chaikin is when oversold is under that 30 line, but then starts to head back upwards. It's just a confirming indicator that, okay, the market is going in our direction. So big movers yesterday, and there were some that were really big. Conagra, I'm sorry, this is CenturyLink, had a upgrade. L Brands has been on a tear for the past 2 weeks. I guess the market likes their new strategy. TripAdvisor, SunTrust upgrades them. So that's why they started taking off. Nectar is getting some good results out of their clinical studies. For a biotech, that's huge. Might mean they have a new drug ready to go in like 3-4 years. Walgreens reported very solid earnings, and the market rewarded them for that. ConAgra, on the other hand, did the exact opposite. They missed earnings, and they missed by a bunch. Now, analysts have been taking earnings down on a frequent basis, the estimates down on a frequent basis. So for them to miss by that badly, it was 36 cents a share versus 42 cents a share. For them to miss that badly means that they're not communicating with the analysts in the way that they should. The analysts should be more clued in, or they simply don't have a good grasp of their business. Either way, that's why the market hammered them. Boeing still having problems with 737 MAX, can't get out of their way. Conoco, there's concerns about liquid natural gas prices. Those have been going down pretty significantly, and so that's a big part of their mix. Nordstrom's, it's just continuation of just bad news after bad news, and Lamb Weston also the same. So yesterday's earnings beats, you had McCormick come in, and they beat by 7 cents, which is great. Nike, which I think everybody was waiting for, they missed by 4 cents. So it'll be interesting to see how the market handles that. Typically with earnings surprises, particularly when estimates have been trending down before the quarter starts, when you miss, you get hammered by the market. So watch Nike today. It could be in for a little wild ride. Walgreens, we already talked about. They had a nice beat, and Accenture beat by 5 cents a share. So today it's going to be a little quieter. Constellation Brands reports, and that's really the only activity. Obviously, a Friday in the middle of the summer, unless you've got bad news, this is not a good time to report earnings. So we talked a little bit about the yield curve. Let's dive into a little bit further, because it's not as desperate, and it's so easily fixed. It's almost like the market is calling out for the Fed to take down the interest rates by a quarter point. You can see the short end of the federal government yield curve is sitting around 2.3. If they had a quarter of a point correction, that 2.3 would immediately go to 2.05, and all of a sudden you no longer have an inverted yield curve as dramatic as what is right now. It doesn't look dramatic, but it really is when you can sort of get 5- and 7-year bonds cheaper interest rate wise than a 30-day government T-bill, which is as safe as you can get. The market is telling us something. The reason why people follow the yield curve is because it's often a precursor to either a recession or a bear market. So it's not a good sign. This is not a full inverted yield curve. For that to happen, you would need the very long term, the 30, the 20, and the 10s to be underneath the 7, which is not happening right now. But it's still something to watch because it's kind of an ugly situation right now. Net, though, all rates are cheap. So for companies that are refinancing, they're getting great rates, and particularly in the mid-range area. The other thing is, I just want to talk briefly about the FactSet does a great job, by the way, with their weekly earnings insights. If you haven't signed up for it, highly recommend doing it. It's a ton of data that comes at you. But one of the things that's very sort of on point right now is earnings for the first quarter were negative. The estimates for earnings in the second quarter are now negative, and the earnings estimates for the third quarter are now negative, according to FactSet. So this blue line, which is the forward earnings per share, that's going to stay very, very flat. And you can see they do tend to move together, the price and forward earnings. So if the blue line, the dark blue line's flat, it's hard to imagine that light blue line getting too far away from it. So for the next 6 months, earnings are going to not be a catalyst for this market any way, shape, or form.